NVIDIA's earnings have moved beyond the era of the simple beat and raise. As we look toward the February 25th report, the market is shifting its focus from basic financial arithmetic to what we call the confidence delta. It is a test of how much certainty investors can price into the long-term AI foundation, rather than just reacting to headline numbers.
The baseline consensus for earnings currently stands at $1.45, with revenue guidance set at $65 billion. This print is a critical event, even for those who don't hold the stock, acting as a primary sentiment proxy for U.S. equities. Because estimate momentum has been unusually static leading into the report, the market's reaction will serve as a systemic test for risk appetite and broader market breadth. This setup suggests that the visible consensus might not fully reflect the actual positioning of major institutional participants.
This is the canonical baseline for the February 25th print. We're looking at a consensus EPS of $1.45 on $65 billion in revenue. What stands out is how static these numbers have remained leading up to the report. Since there hasn't been the usual pre-event momentum, the stock is effectively trading against both these public figures and likely higher internal institutional hurdles.
The staying power of a post-earnings move often depends on three specific factors, especially given this no-revision paradox, where estimates have stayed flat for 90 days. With a shadow hurdle near 153, the official 145 consensus isn't the real bar. For a move to survive, we need to see a positive guidance delta toward that $70 billion mark and margin durability above 75%. If management hints that demand is finally softening rather than just facing supply constraints, it would signal a major shift for the whole sector.
We also have to consider the expectation tax. Options pricing currently implies a move of about 6.3%, which tells us the market has already priced in a significant event. This makes volatility expensive. The hurdle here is that a standard beat without extra fireworks can actually cause the price to slip as that volatility is crushed. To see a move that holds, NVIDIA has to outperform an already high set of expectations. The staying power of a move really comes down to the confidence delta. While a headline beat might provide the initial spark, the market is ultimately pricing forward-looking confidence rather than just last quarter's arithmetic. This is why a beat is often necessary, but rarely sufficient on its own. The actual trend is dictated by the outlook for guidance, margins, and the supply-demand balance. If those forward-looking signals miss the mark, like that mid-$70 billion revenue zone or the 75% margin floor, even a strong report can trigger a sell-off.
The immediate market reaction usually hinges on the guidance threshold, which currently centers on a $75 billion mid-range. Investors are looking past the reported results toward this Q1 forecast to classify the trend. An outlook above $76 billion supports the bull case for acceleration, while a guide below $74 billion introduces visibility caveats that often trigger de-risking. This $75 billion mark serves as the pivot point for the three potential paths we're tracking. While bull extensions and inline churn are the primary focus, the de-risking path carries a 30% probability and often hinges on signal B, margin durability. We are specifically watching this 75% gross margin floor. If the management call shifts the balance from pricing power towards structural costs or transition expenses, it could spark a 6 to 10% downside move. This wouldn't just impact NVIDIA, it would likely trigger a broader reassessment across other high-beta AI names as the market weighs the impact of new product costs. A critical signal to watch is how management frames the balance between supply and demand. The goal is to distinguish between simple operational friction, such as temporary logistics hurdles, and actual demand weakness. A bullish tone would highlight that demand is still exceeding supply, or that they are seeing an improving delivery cadence. Conversely, a bearish signal would involve terms like a digestion phase or mixed timing. These nuances help reveal whether a growth slowdown is a temporary execution issue or a broader shift in customer appetite. Right now, the options market is pricing in a move of about 6.3%. Think of this as the benchmark for the scenarios on your screen. If the stock stays within this range, it points towards scenario B, the inline chop. But a break well beyond that signals a genuine information shock, potentially triggering the bull extension or the de-risking event.
Because these probabilities are priors rather than predictions, we wait for the next session's close to confirm the primary trend and avoid the trap of a gap and fade. One modeled path is the bull extension, which carries a 32% probability. This scenario relies on a clear earnings beat and revenue guidance exceeding $76 billion, backed by a confident tone on margins. If these conditions are met, we anticipate a next-day move between 3 and 7%. This typically triggers a spillover effect, boosting the semiconductor sector through the SOXX index before lifting broader technology names. When the realized move stays inside the implied range, such as the 3% chop shown here, it suggests volatility was simply overpriced. This outcome, which models assign a 38% probability, often triggers a gap and fade, where the market opens strong but fails to hold. If the revenue guide lands between $74 and $76 billion, the stock typically drifts back towards its initial levels, as institutions use the liquidity to lighten risk. In this scenario, the volatility functions as an expectation tax rather than a signal of a genuine information shock. To gauge the systemic impact, we look at Scenario C, the de-risk event. This outcome has a 30% probability and is triggered if revenue guidance falls below $74 billion or if margin confidence weakens. A post-earnings move of 6 to 10% lower in NVIDIA only becomes a broader signal if the semiconductor index confirms the trend. If breadth fails here, it triggers a wider repricing for AI-related growth stocks throughout the technology sector. To gauge the systemic impact, we have to watch for the gap and fade warning. A headline beat isn't always a buy signal. If NVIDIA opens high, but the broader semiconductor index fails to follow, it's a sign that the move lacks market depth. Historically, these gaps can fade quickly as institutional liquidity exits. This is why we wait for the cash open and the management call to confirm if the AI theme has real legs or if it's just single stock momentum. To determine if a post-earnings move is truly systemic, look at the relationship between NVIDIA and the broader semiconductor sector. If NVIDIA rallies but the SOXX index fails to follow, it's a sign of single stock momentum rather than a healthy market-wide theme. Confirmation from the sector is essential. Without it, there's weak evidence for a broader trend, making any spillover effect conditional rather than automatic. Standard reporting data suggests a systematic way to process these results using a 48-hour checklist. The first step is to categorize the outcome as bull, chop, or bear, based on the new guidance. It is then useful to see if the price move remains within the 6.3% implied range. Beyond the initial reaction, we watch to see if the gap holds or fades, and if the broader tech sector confirms the move. Waiting for the next day's close provides a final validation step to help filter out headline noise and focus on confirmed data. To handle the release with discipline, we have to look past the immediate beat or miss headlines. The real story will be in the guidance, specifically whether it hits that $70 billion threshold, and if those 75% margins are holding up. Keep in mind that the 6.3% implied move is basically a cost already paid by the market. Before deciding if a move is durable, wait for broad confirmation from the rest of the tech sector and stick to these explicit rules to filter out the after-hours noise. The final insight is that market spillover is conditional, not automatic. A single stock's movement only becomes systemic when it is confirmed by broader participation. This follows a specific sequence, from NVIDIA to the semiconductor index, then through the QQQ and into the SPY. Durability depends on the guidance and margins we've analyzed, while breadth determines if a signal is truly meaningful. All the data for today's breakdown is in the description. The goal is to avoid outguessing the market and focus on interpreting these mechanics through a consistent process.